How might inflation affect your portfolio? Well, here to talk with me about this is Beau Kemp from Sensible Money. Beau, welcome.
Hey, Bob, thanks for having me again.
Oh, it's a pleasure. So let's start with the basics. What do people need to know about inflation and interest rates?
Yeah, so the last time we had spoke, we really talked a lot about the inflation and it's such a broad topic, but we focus on a few things in particular. And one of them was, that the core inflation versus your typical CPI. And now that was the cause. And now I want to talk about the effect of, okay, when inflation gets higher, what happens to different things in the markets? And one of the main things is interest rates. And so when you look at the basics of an interest rate, and I'll focus on treasuries, there's nominal yields versus real yields. That's like step one. And really what a nominal yield is it has a bunch of different premiums involved in it. And so you'll have your real yield and the nominal yield, as well as some inflation risk premium. There will be a default risk premium, liquidity and maturity premiums as well. When we look at treasuries, though, in particular, the default risk premium and the liquidity premium, they're not really there. And so really, when you look at that, I think the 5-year right now is like around 2.5%, 2.6%. That really all that is the real yield and some sort of inflation risk premium, as well as some maturity premium as well. For the longest time, it feels like the longest time real yields, they've been negative, which is it's always a weird concept to think like, how is a yield negative? But what that means is those treasuries we've had the past year or two, when you break it down, a lot of that yield was just from those maturity and inflation risk premiums that get added into that nominal yield. And this past week or so, when I was looking at this, those longer duration bonds right now, so like your 20 and 30, the real yields have actually gone positive, and the 10 years almost there. It was close to breaking even, and everything closer still has that negative real yields involved in there. And so as we're moving forward, that's one of the things that a lot of the portfolio managers and all the investors are looking at this and getting a gauge on where things are going in the future.
So you mentioned maturity premium. That might be a term that is new to some folks. Why is that so important?
Yeah, so the maturity risk premium is, we'll take a step back and think, okay, if I'm buying a bond, technically, like, I'm giving you a loan, I'm giving you my money, I need some sort of return from it. Well, the longer you have my money, the more return I want. And so in a normal environment, that yield on, let's say, a 10-year treasury or a 10-year bond versus a 5-year, the 10-year should be higher. And you're holding my money for twice as long. I want higher returns. And so in a normal environment, when you look at the yield curve, which is, you'll have your maturities on your x-axis, and so that's like your duration, and then on the y-axis you have your yields. You would see that there's a nice positive slope to it, and the longer you hold the money, the higher return you get. Lately, it's not always a perfect scenario, right? It's never normal, it seems like. But lately, when you look at the yield curve, it has a good increase in the beginning, so especially up to year 5, and then it flattens out. And where this becomes important is if that yield curve inverts, which it did for, I think it was only like a week, but it was inverted there for a little bit, and that can be a leading indicator of a recession. And this is one of those things that leading indicators, there's a lot of them, and they can contradict each other, but it's one of the things that people look at, and it's one of the most common ones too that you'll see people talk about. And if it stays inverted for a while, you'll see more and more articles coming out that there's a recession coming. That's how it works. And so I'm not saying that recession won't or will happen. I don't speculate like that, but it's something to know about, because if and when it does happen, you have knowledge around it. And so, when you're looking at this, it's okay, just think if it has a normal yield curve, then things should feel comfortable for you. As it's flat, that's when you ask yourself, okay, if I need this money in 10 years, so do I buy a 10-year bond or do I buy the 5-year bond, because the 5 years returning the same? It's that's a decision you have to make for yourself, because the only risk there is, if I buy the 5-year, what is my next 5-year bond going to return in 5 years? These are questions that no one knows the answer to, but it's something you have to weigh yourself on. Do I want to tie my money up for the same rate for 10 years?
Yeah, it's an interesting quandary to think about, reinvesting something in 5 years, not knowing what interest rates will be. Speaking of interest rates, they're rising. Any thoughts about what's causing rates to rise at the moment?
Yeah, really, there's a lot of drivers, but one of the main things is, dating back to that last conversation, the Federal Reserve, they're doing what we call contractionary monetary policy. And one of the ways they do this, which they've done it already, is they start to increase that federal funds rate. And when they do that, the reasoning for it is because they saw inflation starting to get away from themselves. So they say, all right, we need to calm things down. Let's weather the storm. We need to try to tame this inflation animal that's approaching us right now. And so that's one of the things. The other thing is, we date back to that a little bit earlier when I was talking about nominal versus real yields. A market is highly efficient. And so when expectations of inflation rise, naturally that gets priced into the market. And so there was a little bit of that as well. So as we continue, there's all these things pulling on it, but part of it was inflation expectations get priced into the market, as well as what the Fed's doing. And the Fed they've told everyone they're planning to continue to do this, and they'll continue to monitor it, but that's what's causing them to rise.
Yeah. So the big question is always, what does this mean? What does it mean for mortgage rates? What does it mean for retirees, for young investors, et cetera? Care to walk us through that? What it all means?
Yeah, with the mortgage rates, this is always a fun one, because real estate's always been, it's one of the main things people talk about in finance, probably because a lot of people own homes and they see the equity in their homes increasing. But the mortgage rates, they kind of track the 10-year treasury. And so as these rates start to increase, we've already seen it, the mortgage rates will start to increase. And I mean, it was probably a year ago, everyone was refinancing and they were getting rates lower than 3%, which is crazy. A 30-year loan for less than 3%. Those mortgage rates now, last I saw, they're dancing around 5%. And so they already have increased. And if you're in the market for saving for a home, that's going to affect you. If you were budgeting for the past year thinking you can afford a $500,000 home, you might not be able to afford that now unless your income has increased as well. And so that can affect everyone. For younger investors, and I say younger meaning anywhere from 10 to 15 years out from retirement or longer, just thinking time horizon wise, this will affect you a little bit, but it really shouldn't affect the way you're approaching your retirement savings. And so when you're saving for retirement and you're investing, you're investing in those passive index funds, and every time you get paid, you're putting money away. That doesn't change at all. And really, this volatility, you will see some benefits as you continue to invest money, because you'll be buying when things hit lows, so you're doing the dollar cost averaging approach for shorter term savings. So, out here in Arizona, everyone, when you have your family, you have kids, I want to save for the house with the swimming pool. So then spring and summertime, I could throw the kids out back, let them swim, let them have a good time. Those homes cost a little bit more money. As you're saving though, now we can start looking at, okay, maybe I want to buy the home in 3 years. I can park some money in a 3-year CD where I can actually get a return, versus my savings account lately, your savings doesn't return anything right now. As these rates start to increase, you'll be able to find some sort of return on your savings in a money market or a CD. And so inflation will kind of eat away at that a little bit, but I'd rather get 2% on something than 0% with the inflation. Like, try to get every little thing you can, but keeping that money safe and secure. For the retiree side, so here at Sensible Money, we use the asset liability approach. And I actually get kind of excited with the higher rates, because now I can build a bond ladder. So when I started, it was you'd buy 7-10 years worth of expenses that we need, and it was all safe and secure bonds. And so whether it's CDs, treasuries, agencies, whatever it is, all AAA rated bonds, as those bonds mature, that's what funds retiree savings. Well, when the pandemic hit, rates were so low that we had to kind of pivot. We only felt comfortable buying those for about 2 to 3 years. And then beyond, it's really hard to justify, why would I keep buying these CDs or these bonds when I'm getting a % return? And so we found some alternative ways. We found funds that we trust that they'll provide us some sort of return, but our money will still be there when we need it. Now I can build that bond ladder out close to 5 years, feeling comfortable with that rate of return. And then I can start using those funds. And the reason I like this is because the funds, you are taking on a little more risk, because in order to get that return, you have to have a little more exposure to equities. Whereas when I'm just buying bonds for each and every year, I'm 100% confident that that money will be there, because as the bonds mature, it's there. I don't have to worry about price fluctuations. And the bond funds, even in the bond funds themselves, I do, because it's, the prices go up and down as the yields rise, the bond prices fall. Well, that can affect your bond fund. And so I like being able to buy those individual bonds for clients. Just makes it feel a little more comfortable.
Yeah.
On the inflation side for retirees, this is actually, I get really excited about this too, because I read all these studies, and you can educate yourself and analyze statistics about retiree spending typically doesn't keep up with inflation. And I trust everything I read when I look at the numbers, but it's still like, I want to see it happen, right? And so like, until you see it actually happen, then you're gonna be, okay, I understand now. And we have a small handful of clients that have started to say, hey, we need a little bit more money. We've been seeing inflation in the news for quite a while now about how high it's becoming. And for people to just now start asking, that's really proving these studies. We have a good little sample size here of, you know what, it's, people might increase it, but they're not asking for the 8% increase either. It's, we need a couple extra $100 this month. And so this is also, it's part of that's tied to how much they spend in their asset level. If you have a lower asset level and even lower income as well, the inflation can hurt you a little more, because what you're buying is the essential expenses. We've all seen it's happening with gas prices and your grocery bills. That's the talk of the town. But if you have a little more discretionary in there, you don't have to be worried, because you don't have to keep up with that 8% as you go.
So, Beau, we've covered a lot of ground. I'm going to throw a curveball at you. We're talking here in mid-April. The Fed will be meeting and presumably raising interest rates yet again. The talk that I'm hearing is that they would increase them by about 50 basis points, or 0.5%. Any thoughts about that, if that's the case, and what people need to be prepared for if as we watch the Fed continue to fight inflation?
Yeah, I think that it's really, I think it's going to be a toss up, honestly, between the 25 and the 50, and no one really knows. And the Fed probably doesn't even know. They're going to continue to monitor things. But in terms of what we're doing, personally, I don't like the idea of speculating. I like having a disciplined approach and building the investments in your model. It's fun to read, and it's good to have knowledge about what's going on, but I don't want to try to time interest rates, because historically that hasn't worked for people. It's the same as trying to time the stock market. So do I think they're going to increase? Yeah, I do think they're going to increase, and I think they'll continue to increase, because they really kind of have to. There's going to be a lot of people that, the inflation is their big issue right now. And this is what we have. There's economic beliefs out there that the Fed shouldn't exist, but you know what, this is our environment. And so you have to trust them, right? So they're going to do their job. And from an investor standpoint, if you stick to your process and you stay disciplined, it really shouldn't matter what happens in the long run, because there's always something going on. It doesn't matter. Like, if you date back to any year, any decade, there's always something, there's always some sort of fear. This is today's fear.
Yeah. All right, Beau, we've covered a lot of ground. I want to thank you for sharing your knowledge and wisdom as always with our readers and viewers. It's greatly appreciated.
Yeah, thank you for having me, Bob. This is great.